Welcome, everyone. At first, I just want everyone to give themselves a big round of applause for in Washington State that we're actually out and about. We're back, baby. I think it was 2 years ago in February, I gave the last one of these in front of a group of people. And I got a call sometime in April or May, would I do one of these over Zoom? So I said, of course. So I got all set up and I had my monitor. And then all of a sudden I went to go start it and I didn't see any people. And I totally froze. And it was the hardest presentation I ever gave to not get any feedback. So it's so nice to be here. I really appreciate everyone showing up today, coming out. It's awesome to see everyone's faces. Want to start a little bit with a round of applause for Cassie on our team, who's new to our team. Cassie, a little appearance. Cassie's done a bunch of these over Zoom, and we said we're going to do one in person, and she said when, and it was back in October, and we couldn't put it together. So about 2 weeks ago, we said, let's do it now, Cassie. And she said, well, I doesn't have a month to prepare. I said, we don't have a month. Let's get this together. So she did an awesome job. Really appreciate it. Next, thanks is to the team here. Wouldn't be able to do this without a fantastic team, a awesome business partner, Jared Anderson. Thank you so much for giving me the spotlight today so I can come up here. Also, Matt Laird on our team, Brandon Lawler. Winslow Lee is not here. He's getting married on Saturday. So in his absence, we're going to take a little to-go box for him. And then the newest addition to our team is Max, covering Eastern Washington. And what you don't see on the screen also is Jack Cunahan, our analyst, who makes all the wheels behind this work. So thanks so much to a great team. We were really, really fortunate to have such an awesome team. Just a little bit of our specialty in transactions. Most of you guys know us. Just crested over a little over $1 billion in sales, a little over 5,000 units. And we're spending a lot of time doing development land. It's probably about half of our business right now. And we're really fortunate to have a pipeline. We've got 35 active transactions that are on the market and pending, 37 as of this morning. So we're really busy. We're excited to serve our clients across a broad things of what we do. But here we're really focusing on the research and the data that we do. Got a new research report that's on everyone's tables. Want to highlight a couple of things since we revamped all of our research over the last year. And what we're trying to do is take your feedback and make it more actionable, because there's a ton of data out there, but most of it's not very good. And we didn't think ours was up to snuff, so we revamped a lot of it. All of this is available on our website. You have a copy here. So a couple of key changes. First off, frequency. We're starting up with quarterly releases. So within a month of every quarter, we're going to release a new market research report. It's going to cover all sales, rental rates, and vacancy rates, covering apartment buildings, 4 Western Washington counties, 5 units and up. And the analysis now has 90-day and 12-month trended data, because so much is happening so fast. We're trying to make the information more actionable and usable for you versus just using it as marketing for us. Last is specialty reports. We're still doing a development report that comes out in the spring, and a micro market study that is coming out next week. So take a look for that. As far as our agenda today, taking a quick regional overview of the 4 Western Washington counties. Next, some sub-market insights in each one of the counties, some near-term forecast, and some long-term forecast. So without further ado, a quick regional overview. First off, looking at historic rent and vacancy, you've seen these graphs before. This covers all 4 counties, so it's blended data. What's interesting about it is we've had really strong rent growth. Now, no big surprise, 2020 it went down, and that's been good. We're back up pre-COVID. I think what anchored us was the suburbs that kept rents from dropping too far. We had some collection issues in the suburbs, but now with the urban markets, we're above pre-COVID rents across all of the counties. And we'll take a look at each submarket, how that's being impacted. As far as vacancy rates, this is blended vacancy. So this covers new buildings under development. So it's slightly elevated, but if you look at the trended data, we've been somewhere between 5.5%, 6.5% vacancy, and now we're down to 4.4%. So the market has come roaring back. Always never talk about your past predictions unless they're right. My prediction was we wouldn't be back until about spring or probably about fall next year. So I'm really surprised how quickly we are back. I think some of the pundits believe we wouldn't come back till later than that. Of course, they've all reversed course and said we're back now. I'm really impressed with how strong the markets are overall. We'll dive into each of them a little bit more. So here's the format of our trended data on a 12-month and 90 days, so quarterly trended. So this is Q3 2021. That's what you just saw. Rents are about 1873, vacancies about 4.4, blended with new construction. If we look back 90 days, you can see we've had good rent growth over the last 90 days. Occupancy has gone up, vacancy has gone down, but the big highlight here is the change over the last 12 months. So over the last 12 months, we've gained all that we lost in rental rate decline and then some, and we hit this peak vacancy. We're back down again, but it happened pretty slowly over this last 12 months, and we'll talk about which markets were leading and lagging in that category. But from a broad overview, we've really this last 12 months picked up to where we were before this. Now, I don't expect anyone to understand or be able to read this at first blush, but we have some new stats that we're using called building income velocity. And what we're measuring is how much income in the form of rent and occupancy of buildings. So just taking a snapshot of this, what we're looking at is rental rates over the last 90 days and 12 months. And with an excerpt, you can compare different markets. So just by way of example, we're comparing Urban King and what we call Urban Tacoma, up and comer. Not everyone breaks out Urban Tacoma, but we're a believer. And we're looking at the rental rate changes over 90 days in 12 months in each of those markets, as well as the vacancy rates in those markets. So just wanted to show this to you to highlight some of the new research that we're doing, taking a little bit more of a regional look. So next, we're looking at historic sales across the region. What we're looking in the red dots is this is number of transactions. The blue bars is dollar volume. So this first click here shows that we've been above about $4 billion in dollar volume since about 2015. You can see the spike in 2019. That was the excise tax change year. You can understand why that was changed. Now, what's interesting here, so we're at 4.4 billion this year so far. Our forecast is we're probably going to be up over 6 billion this year. There's still a mountain of transactions that are going to happen that are going to get recorded in the next 30 days or 25 days. So we expect this to pick back up. This is from Q3. So it's been really incredible. But the interesting aspect of this is if you look at the number of actual transactions, they declined in 2020, which was expected, but they're still fairly low. And that's because most of the transaction volume in 2021 has been larger, more institutional deals, pent-up capital, low interest rates, and basically, we're one of the best of a bad lot of markets across the West Coast. People believed in the Puget Sound coming back, and institutional buyers wanted to deploy capital and get it to work. Now, in 2020, we had more private client transactions that weren't as focused on the capital market. So it's been interesting to see just from a sales volume standpoint, how 2021 is going to be a fairly banner year, but mostly on the institutional side. Taking a look at the actual sales values, red dots are cap rates. The blue bars are actually price per square foot. We've always used price per unit because unit sizes vary so much at this point. We're leaning more towards that price per square foot metric as an overall metric to compare markets. And so you can look here, we've had a steady increase. There's a bump up in values on buildings from a price per square foot in 2019. 2020 wasn't that far. We didn't fall off that much in actual values where we fell off as a number of transactions. So we just had owners that weren't sellers until we cleared that part of the market cycle. And if you look at cap rates have continued to decline. So overall, from a sales value perspective, the market is extremely healthy. And I forecast it's going to stay healthy. But I think it's been a big surprise to people how much we've come back and how quickly it happened. Taking a quick look at 2019 is we haven't quite crested sales values in 2019, but our cap rates are down. So the only aspect that's really this big change is NOI. NOI is down quite a bit and cap rates are very compressed. And really the $1 trillion question in commercial real estate is, by the time those NOIs come back up this coming year, will cap rates have expanded or not? And that really is the big question for sellers right now of how to time this market. Next slide is what we call building price velocity. This is another metric that we've created with our new research. This is looking at across the region. To excerpt that, we're taking a quick look at Urban King versus Suburban Pierce in this case. Urban King, looking at price per unit and price per square foot compared to Pierce, it's about half. So obviously you've got more new product in Urban King than you do in Pierce, but you're seeing why a flood of investors are looking for value in other markets, different politics, different price points. So this is just some other data points that we think will be good looking at this market from a holistic perspective. So that's it for our for our regional overview. We're going to dive into the markets, and the way I structured this presentation to be a little bit more exciting, I'm hoping, than 70 pages of research. If turn to the next page, is what we've done is we've picked out 3 insights from each market that we think are interesting. Hopefully what you'll do from our research is take a spin through it and find some insights of your own, and hopefully they're actionable. But we're just really restricting our comments today to just insights that we think are interesting from each of these markets. So first off, starting with Urban King, number one is the rental rates exceeded 2019. So you can see that dip that we had in 2020. We're now above the dip. We're not a huge amount above the dip, but it's excellent that we've cleared that. You can see what happened in 2019. Rental rates dropped, vacancy spiked, and here we are. Rental rates have exceeded previous peak, and vacancy is now below where it was the previous peak. And we're about par with where we were in 2019. So we've got a road well on the way to recovery for Urban King County, and it's been surprising it happened so quickly. Next is we've been a last to recover market. It's probably no surprise if you look at the current quarter, rents are about 21.33, vacancy is 5.4%. But if you think back to the regional slide, in the regional slide, it was a 12-month recovery. In Urban King County, it's really been a 90-day recovery. And this is looking back at Q3. So we're already a few months past that. But the recovery really happened over the summer. So over Q3, that's where we had a big change in rental rates. We had a big spike in rental rates over the summer. And if you look back 12 months, that's when we had a change in occupancy. So in the urban core, we had occupancy went down. In the suburbs, occupancy didn't really fall, collections fell. But in the urban markets, we saw occupancy really drop. In some markets, we were seeing 15% vacancy rates, up to 20% vacancy rates. So that was the recovery that took hold over the last 12 months. It's really in the last 90 days that we've seen the rental rate velocity come up, and that's showing the momentum in the market. And I think that momentum in these urban markets is going to continue, but for what we see happening with office space in next year, and we'll get to those comments in a little bit. Last one, third insight from Urban King County is just cap rates have compressed to the lowest in its history. And so I think this is just one of the biggest stories in Urban King County is cap rates are extremely low. So as of Q3, we're reporting them about 3.8%. Now, this is one of the biggest challenges in the market right now is, you know, I always say there's 4 cap rates: the buyers, the sellers, the brokers, and the real. And the first 3 can vary widely from the real one. And really, since Dupre and Scott, and at one point I'm going to stop talking about them, but today is not that point, where we actually had Patty calling us asking not what the cap rate was, but what income was and what expenses were and what tax numbers we were using. And that helped harmonize where cap rates were. Real Capital Analytics didn't report it what I figure is correctly. CoStar didn't report it. So right now we have a big variance in what cap rates are. So we're hearing 3.3 cap deals, 3.8 cap deals, and there's a lot of noise. Is that on adjusted rents pre-COVID? Is it trailing numbers? Is it T3, T12? So there's a lot of noise in cap rates. So the big picture, they're low, and they've been low. And the question is, are we going to look at these harmonized of 2 buildings sell, one had stabilized, one had not stabilized, same vintage, just different operations and how the owner operated, were they offering concessions or not? So I think cap rates are a touch artificially low right now, but they've been declining. Year to date was 4.1 and 2020 was 4.7. I'd say the peak of the market in Urban King County, cap rates were around 4 to 4.25, depending on the product type. High rise, maybe they're a touch under 4. Mid rise, maybe not ideal location, maybe they're 4.2, 4.3. But the fact of the matter is, in the urban markets, we've had a huge compression of cap rates, much more so on the east side. When I say urban King County, I'm talking west of 405, but even east of 405, we'll get to East King County a little bit. We've had really compressed cap rates. Now, next, looking at North King. And North King was one of the more interesting markets to analyze. It's not necessarily one of the hottest markets that people talk about. If you look at this, we've got Crown Hill, Greenwood, Northgate, Lake City, we're seeing a lot of action up there. Shoreline, we're seeing a lot of action. The market's been fairly sleepy, and it's one of the few markets where we're really wondering how the investment community and how the ownership community is really looking at this market. Because if you look at where cap rates are, they're still fairly elevated. And you look at rents, we've had modest return in rents, but they haven't really bounced back. If you look at 12 months ago, they were around 1537. They've come back a little over $100, where other markets have come back $150, $200, and cap rates are still high. So what we've seen is the rental rates have come up, but it's one of the only markets that with rental rate increases, we've actually seen occupancy decreases. So that's that point of equilibrium where we're finding out we can't really push rents too much higher. And the question is, it used to be Snohomish County, people would leave North King and move up to Snohomish because Snohomish was cheaper. Average rental rates in Snohomish are higher than North King right now. So it's really interesting what's going on in that market. And I think that there's going to be some opportunities in that market. And that's why I hope you can glean from some of the insights in the report. Next on the same trend is transaction volume is anemic. And if you look at how much it's fallen off and how much it's recovered, we have very little transaction volume in North King, both large buildings and small buildings. Very few actual transactions, and volume is really low. It's just curious right now. There could be some opportunities up there, especially if you're trying to compare cap rates. I think there's some opportunities for a buy up there. I think people are trying to figure out where rental rates are. Our prediction is we're going to see a lot more rent appreciation in the core, and people are going to get pushed back out to North King once again. And also commute times are going to pick back up, and people are going to leave Snohomish and come back into the core. And that's that pinch point. And we're going to see that in Shoreline. We're going to see that in Lake City. We're going to see that in Greenwood. And I think those markets are going to take off. But right now we are so focused on what's happening in the suburbs. We're not seeing those dynamics that were created pre-COVID because we think everything's changed forever. Well, news, folks, it hasn't. We're just going to revert back to the mean that we were on before. Finally, is pricing strength not yet returned? We talked about this a moment ago. It's been the theme ongoing of how we're looking at North King. If you look at cap rates, they're okay. They're about 4.5 blended. But if you actually look at price per square foot and price per unit, they're not back to where they were in 2019. And the averages have not come back. So NOIs are still down. Cap rates have not pushed back down again. But I think the fundamental is if you have rental rate growth, eventually you're going to have pricing increasing. So I think there's a strong story for North King that people are missing right now. Next, turning on to Snohomish County. So Snohomish County has been an interesting county to watch. We saw a little bit of stall out a couple years ago because everyone had done so much AC rehab and value add in Snohomish. Rental rates really pushed up. We were seeing renters getting fatigued in that market. We were starting to see vacancy rise with rental rates coming up. And we were hitting that point in Everett, and that seems to happen every cycle, is that bellwether that the market's getting overheated. So here's some new data that we're producing in this research report. This color coding is building vintage, with that gold color being the oldest buildings and moving on to the newest buildings. So what we're seeing, oh, wait, we've moved on. Wait, I screwed up a slide here. Pardon me. We've moved on to East King. I'm not to Snohomish yet. My bad. East King County, east of 405. Your books are right. Slide was wrong. Switching over to East King County, this is what we found in East King County. Rents are $2,500. And this is in buildings that are a touch older than new buildings. So that's what's really crazy. Now, part of it is these buildings actually have larger units. And that's why bulk rent is up, because the average unit size has been coming down in East King, probably like everywhere else, about 100 square feet per decade, but it had not come down as much as the Seattle markets. So in East King, which is, you're looking everything east of 405 And these markets have been really hot, the hottest markets. So greatest rental rate growth, highest rental rates. And you look at 12 months ago, rents were cresting 2,200. Now they're cresting 2,500. So the entire East Side has been the sweetheart market in the entire region. And I think we've seen it in the paper. We've seen it all over the place with sales closing. Is we've seen really, really strong rental rate growth, low vacancy, and a lot of investor demand. And part of what's driving this is the fact that rents have picked up so much. So if we look at actual sales volume, this is 2021 year to date as of Q3. So I know of at least $500 million to $750 million of transactions that are pending right now in East King that will close before end of year. And so I expect this number to crest $2 billion in East King. Now, what's interesting is if you look at back in 2019, they hadn't even crested $1 billion. 2020 was about half that amount, but the transaction volume hasn't changed. Institutional buyers snapping up very large, very high-priced properties on the East Side. And that's why we're seeing such massive transaction volume there, although cap rates have not come down. Now, or pardon me, although the transaction size has not come down. So wondering, what about small transactions? There's just not a lot of small buildings on the East Side. So we see transactions occur on the East Side, but most are newer construction, institutional grade properties. This is a trend we don't see ending anytime soon. As long as we have sellers, we are going to have buyers on the East Side. And this transaction volume, I think, came as a surprise to everyone, but it's a trend I don't think we're going to see end anytime soon. Next, this is just carrying on from these trends. It's not a big surprise why we have sellers on the East Side. Is year to date as of Q3, cap rates were 3.3. Now, most of these buildings were operated pretty similarly, many new construction sales. So we were trading off of COVID rents. They were on lease up. So I think there's some artificial noise in these cap rates because there's several of these buildings that were lease up buildings, not fully stabilized. But talking to the buyers about their underwriting, the pricing was so strong that many of these buyers are hoping to get to a 3.5, a 3.75 cap 2 years from now. So we have a lot of new construction on the East Side, but there's also a huge amount of forecast demand on the East Side. So if you look at Q3, we're at 3.3. Year to date, we're at 3.5. 12 months ago, we're at 3.8. You can see the trend. Now, I don't think we're going to start seeing things drop below this low 3 cap over there. We're starting to see rent rolls repair. Things are getting a little bit more stabilized all over the region. The question is really going to become, are sellers still going to expect these low cap rates when we've got rent rolls that are more stabilized, trailing numbers that are a little more stabilized? Are people still going to be expected to land in a mid-3 to high-3 cap range in building sales for stabilized buildings? And like I said before, that's the big question. I think it is most highlighted on the East Side because that's where we're seeing the highest transaction velocity from a number of sales that are high price sales and pure dollars. South King, I'll get this one right. So turning to South King now, South King has been one of the most heavily traded markets and one of the strongest markets, I'd say, the last 10 or 12 years. Every time I come up here and I'm pulling together slides, I'm looking at what happened in Seattle and what happened in the urban markets, and we look at pure transaction volume in South King, and we look at the investment dynamics in South King, and it still reigns supreme. And we'll see some of these dynamics. First off is consistent rent growth. So here's the rent growth. COVID impacted South King a little bit more than it impacted some of the further out suburbs in KISTAP and Pierce County. But we were about par in rents last year. We had a little bit of growth from 2019, but really steady run up in rents. And if you look at vacancy rates, you're starting to see in 2014, 15, 16, the response to the run up in rents. Vacancy is starting to pick up. And we're starting to hit that equilibrium I was talking about. We have to decline pushing rents because occupancy is falling off. And then all of a sudden COVID hit, occupancy completely fills up. Now, what's not shown in here is collections. And that's the big issue. And that's the challenge in the suburban markets is in 2020, they were averaging probably 8 to 12% collection loss. Whereas in the urban markets, we had maybe 2 or 3% collection loss, but vacancy rates ticked up to maybe 8 to 15%, depending on the market. So what we traded in South King is more occupancy, but less actual collections. But even as collections are picking up, you see from here, vacancy rates are very, very low in South King. And this is people staying in their units and seeing more demand. And part of this is rental rates have picked up in the urban markets. So this is the flight from the core that we saw last cycle in 2013, 14, and 15. And so people are not quite rushing back into the core because they can't afford to if they're living in Renton and Kent and some of these further out markets. Largest decline in number of sales. So this is what was surprising. We're seeing about 35 to 40 sales a year, up to 60 to 70 sales a year in South King County. Heavily traded market, acquisition rehab market, lots of dynamics moving there, showing that we're having investor demand responding to the rental increase and low vacancy. Well, what's happened now is we've actually seen a decline in sales. And I think what's really happened is owners were afraid to sell their properties because they had so much collection loss. They weren't certain the investors were going to be there, and we've had just less sellers in that market. That has boosted up pricing, but it's somehow forestalled close or actual closed sales because I think people are a little bit uncertain. I think that's going to start to really pick up coming into next year, especially if interest rates stay low and we see that constant rent growth. But it's been surprising to see how few sales we've actually had in a market that heretofore was the most heavily traded market in the region. We're at a 10-year low in South King County of actual transactions. So there's going to be a pent-up demand of people that are end of fund life, end of debt life, and looking to sell. So I think there's going to be some opportunities down there. It's going to be a question of pricing, which is, the dynamics that we're looking here. You can see that huge compression of cap rates coming back as far as 15 years ago. It wasn't uncommon to be 6.5 to a 7 cap market, 7+ cap, and it's not surprising to anyone in this room. Over the last 10 years, we've seen those cap rates dip down to about a 5. Well, in the last year, they've dipped down into the 4s. And so you see that pricing escalation. This is what the actual transactions show in South King is how aggressive the buyer pool is. So try not to make this slide too complicated, but this is highlighting another aspect of our research. We bifurcated between markets. We also looked at segmentation by vintage, so age of buildings. And we've also segmented by under 50 units and over 50 units. And generally under 50 units, not as professionally managed, operate a little bit differently. And so we're trying to show some segmentation. So to simplify this, the boxes I'm highlighting are transactions over 50 units. And these are larger transactions, probably averaging $20 to $50 million transactions. And what's been interesting is looking at price per unit, we've seen an escalation of about 20%. So those of you that are buyers in South King County, back in 2017, 18, 19, we were hitting that $200,000 a unit metric. It's like, wow, we finally hit it. Now we're staring down the $300,000 a unit metric. It's absolutely crazy times down there. And if you look at price per net rentable foot, we've all been watching, when do we hit $200 a net rentable foot? Well, we're now averaging over $300 a net rentable foot. So the question becomes, well, are we buying based on actual income that's in place? Are we buying on income forecasts for the future? And that seems to be in every market cycle. No, we're buying as a metric of replacement cost. And that seems to be where we are every cycle. When we tap out on actual economics, we look at replacement cost. And that's something that's happened in South King County. And it's shown a lot of aggressiveness. And you look at where these cap rates have declined, they haven't got quite as low as the core, but the actual appreciation of the units on a price per unit and square foot has been a massive appreciation in South King County. And I think the big question is, are buyers next year willing to pay the freight to transact in these markets? And it's a market that has been the best payout market of all of them, maybe outside of urban King County and Seattle the last 10 years, and now Bellevue on the east side now. So it'll be a big question about transaction volume next year in South King. I got these slides switched up. This is Snohomish. I caught it this time. I'll update the deck before we send it out. We're back north properly this time. So North King, one of the things that we've seen is we've seen sustained rental rate increases, but if you look at the actual vacancy, it's kind of bobbed up and down for a while. And the problem in Snohomish County is we've had, every time we've tried to raise rental rates, occupancy has fallen off. People have moved out to Monroe and Marysville, and they've left the inner Snohomish County because you can move 5 minutes further away and not hit much traffic. You can't do that in Seattle, can't do that as much in North King. Well, the dynamics that we've seen is rental rates have completely popped in Snohomish County and vacancy's gone down. And this is just a testament to the COVID effect, is people want more space. They don't have to be in the core, and they want to be in these further out markets. And even though rental rates are coming up, people are not moving out of their units. So this is one of the strongest trends. If you look at this actual increase in rental rates, we haven't seen this since 2007, 2008. And if you look back on the slide 10 years ago, that's where vacancy really peaked. And that's what happened last cycle, is we did these ACC rehabs, and then people got caught end of cycle in 2007, 8, 9 up in Snohomish County, and they'd over improve their properties. So the question now becomes, is this a market for new construction? Are we going to start to see more new construction in Snohomish County to pick up the slack here? So it's been interesting to watch how that market's behaved. Looking at actual building sales, again, segmenting between smaller buildings and larger buildings, and this is the data from our report for Snohomish County, and we had this for each county, is what we're looking at. The top graphic is buildings under 50 units. The bottom graphic is units under 50 units, and this is trended. And what's been interesting is if you look at rental rate growth from 2019 to Q3 2020, it's increased about $60, which is not a huge increase. Now, occupancy has gone up and vacancy is quite low. It's 3.1. But if you look at how operators of larger buildings are operating, look at that bump up in rents. It's been huge. It's been over $250, but it has not been at the sacrifice of occupancy. Occupancy is still sub 4%. So for those of you that are interested in assets that are a bit smaller, this tells us there's a dislocation in the market. As there's an opportunity up there, there's not as much NOI with these smaller buildings. There's still a lot of room to increase rents before you catch up to these older buildings. So there's some opportunities up in Snohomish. I think it takes some digging, but that market has remained really strong. I do think as the cores come back, it's going to pull some renters out, but I also think there's some people that have just changed their lifestyles, and they're going to be more suburbanites going forward. Next is the pricing didn't escalate, and that's not too surprising looking at those dynamics, is even though we've had really strong rental rate increases and really low vacancy, you would think investors would be flocking to that market and identifying that. And if you look at 2019, if you look at that pricing, average price per unit was about $230 a unit, about $272 a net rentable foot. And then you go to year to date and Q3, we haven't crested 2019 pricing. We've actually declined from that pricing. So it tells us there's some opportunities up there, at least to the extent you've got owners that are willing to look at sales comps as a guide to what's going to happen with their sale. We think there's some opportunities in Snohomish County that the market hasn't yet identified. Moving to suburban Pierce County overall, we're going to look at urban Pierce and suburban Pierce together. This has been really a sweetheart market. We've seen a big push into Pierce County. So quick slide on urban Pierce. We like the urban story. Everyone's opening up the paper every day to wait for the Google announcement, the Amazon announcement. I think they've been waiting for that announcement for 10 years in Pierce County and in Tacoma. I'm not here to make it today, but I do think we're finally at that point where Tacoma's not just the up and coming market. I think this next market cycle, we're going to see strong momentum down there. Just from a number of transactions standpoint, hasn't jumped up, but we do see we've had some large sales. Now, admittedly, most of this is an $80 and $85.5 million sale in Point Ruston that accounts for most of this volume, but we have other sales that we know of that are going to hit in urban Tacoma, and we're seeing lots of new construction. And as we know, Oftentimes these developers are merchant and they're going to sell, or they're just going to look at the pricing dynamic. So we expect to see more transaction volume and higher price transactions in urban Tacoma. I think that's going to draw in more capital, and it's going to create that effect of that flywheel effect in Tacoma and more confidence in that market. Now, we still are waiting on some more employer announcements, but as we're seeing employers push out, be more hub and spoke, like we saw REI do when they left the Spring District and go out and have their biggest hub is Issaquah, and they're going to develop a bunch of spokes. They've been kicking around sites sites that we have listed down in Tacoma. This is REI. So we have some of these employers looking out from a lifestyle perspective. So we think we're seeing the nascent stages of this really take effect. Lowest rental rates and vacancy in the region. So this is really interesting. So some people look at, we've had really strong rent appreciation. It's a really strong market. We're looking at this a little bit opposite. What market has the most room to run? So if you look at average rental rates in Pierce County, they're just over $1,500. Average rental rates in Snohomish are about $1,650, $1,675. And average rental rates on the east side are over 2,000, Seattle around 1,900. So they're still bested, overall by $200 or $300 from most other markets. And we see that as a great ability to push rents in those markets. And then you ask, well, how much can you push them? Well, average vacancy rate is 2.5%. It's the lowest in the region. So even though we've had a lot of rental rate growth in Pierce County, and we've had a lot of people move into those markets, we still have not seen that pop in rents, and we think there's some opportunity there. So that's our second and third insight is both rental rates, is both actual transaction volume picking up and where the pricing lands. So finally, looking at KISTAP. KISTAP's that way, if anyone's wondering. Not everyone's ventured out there, but more people are venturing out there. There's a fast ferry. There's things going on. There's a lot of military contracts. I joke a little bit, but we sold a property in Kitsap County. We scratched. This was in the middle of COVID. This was a March 30th closing. Maybe we were a little nervous, March 30th, 2020, if we were going to have a closing. It's a great client of ours. They closed on it for $16.2 million. They just refied for $27.5 million valuation. Kitsap. So it has been a remarkable market. People are concerned what happens with the military contracts, what comes and goes. I think there's much bigger dynamics playing out in Kitsap County of what's happening as people push out of urban King County. Where do they go? Livability, remote work. I think Kitsap's going to be a major benefactor of all of those dynamics. So here we're looking at a segmentation. We're looking at buildings under 50 units, and we're looking at a segmentation of rent versus vacancy in the last 12 months. What's been interesting is older buildings in Kitsap are at a far greater deficit on an income perspective to the new construction. Now, new construction is capturing a huge amount of rent with these new buildings, but these older buildings are lagging behind. And mostly it's older ownership that have not optimized their properties. There's not a lot of bigger buildings out there, but under 50 units, there's a really great opportunity in Kitsap County because the market's proving out you can capture these higher rental rates, and you can see it with the new construction. There's a big delta there shown by the data. And if you look at what's happening with the actual vacancy rates, they were quite low. So in the last quarter, they were 1.5%. So there's something going on in Kitsap County. There are definitely older or owners of older, smaller buildings that are not paying attention to the market. Next overall is cap rate compression. You can see not everyone's loved Kitsap County over the years, but what's been incredible is, we're seeing 5 cap deals there. It used to be people were surprised that we were seeing 5 cap deals in Pierce County. Now we're seeing 4 cap deals down there. Now, are these cap rate compressions, they here to stay? One adage I had, we're sort of the middle of last cycle, calling us on average regionally a 4.5 cap market. San Francisco was a 3.5 cap market. Vancouver, British Columbia was a 2.5 cap market. So as commercial real estate becomes less of an alternative asset class, we're just seeing returns get bid down. Now, that's great if you're a seller, maybe not as great if you're a buyer, but I expect we're probably going to normalize this cycle about a 4 cap. probably go down 50 bips from where we were last cycle. And I think all these markets are going to move down. I don't think necessarily Vancouver is going to be a 2 cap market, but maybe it's a 2.25 cap market, or maybe that market just blows up because people can't afford to live there like the Bay Area. But I do see good things coming. And I think KISTAP is one of the benefactors of that. And if you look at the actual average price per square foot, it's still around just over $200, where the rest of these suburban markets are ticking into the high 200s to low 300s. So if you're looking at a price per square foot metric, replacement cost analysis, KISTAP still has some opportunities, which is our third slide. If you look at actual number of sales, we've had, as of Q3, 234 sales year to date. 3 were under 100,000 unit. Thank you, Mr. Enslow. Goodbye. 94 a unit. 4 of the 5 transactions in the region under 100,000 a unit happened in Kitsap County. So it's just interesting. That's where the data fell, but there are still opportunities in those markets as everything's become more expensive. And I think as we've become more urbanized, and we'll talk about some of these long run trends, investors are getting a little bit more confidence about going out to these markets, and it not just being a COVID fluke, that people are going to go out to the suburbs and come back in. So as far as a forecast, first taking a look at some near-term fundamentals. So where we're focusing in the near term right now, first off is urban core. And really what we're happening right now is a balancing act. We've recovered from an occupancy standpoint. Most buildings that want to operate at full occupancy are operating at full occupancy. It's really going to be this delicate dance of increasing rental rates without decreasing occupancy and focusing on new supply. So if you're building a high rise in South Lake Union, there's going to be some challenges with competition. I think our pipeline report shows about 6,400 units in the pipeline in Belltown alone. So there's going to be some challenges when those people break ground, what's going to happen with occupancy. But I think the past is behind us of falling rental rates. The question is, can you continue to push rental rates, keep your occupancy, and balance with new supply? Next is suburbs. The challenge for the suburbs continues to be collecting rent. That is vastly recovered from where we were before. We've probably collection losses. We're in the middle single digits. We're not in the double digits. And the question is, how much can they push rental rates and still have full buildings and collect all their rent? The suburbs are still doing terrific. I think they're going to face, from an investor standpoint, some competition with the urban cores because the urban cores are recovering so strongly. Next is operations and expenses. Now is really a time to retool your technology and monitor expenses. I don't know, anyone in the room negotiated salaries with an employee recently? Talked to a vendor recently? Everything is getting more expensive, and I don't see those inflationary pressures really abating anytime soon. The big thing I'm looking out for is stagflation like we had in the late 70s that stuck around kind of the mid 70s into the 80s until we dealt with it with massively rising interest rates. That's probably the big bogey out there. But the question is, buildings have recovered, but now they're more expensive to operate. So in the near term, I think one of the biggest opportunities is optimizing operations and taking this time to retool and figure out how to operate your buildings more efficiently. Next is sellers. We've got to be careful not to confuse near-term market reactions with long-term trends. And this is what I was talking about with where cap rates are. Are they going to move up? We don't really know. We all like to think that they're going to stay compressed, but that can be some dangerous thinking. I think what we got into is this thinking by the end of 2021 or 2020 that we need to get back in the market. We want to buy investments. These rent rolls will recover. Well, once they're recovered, what sort of upside, where do we need to be on a stabilized basis? And I think that's a near-term phenomenon we're going to deal with in the next 6 to 12 months. Next is new normal. Is this where we are? And I don't think so. I think we're going to see some market oscillations. And I was having a discussion with a good friend about, do we just see a market reaction in the urban core with rent growth really spiking in the urban core in the last 90 days? Because what precipitated that is announcements from a lot of tech firms are coming back to the office. So were people moving back to the urban cores, getting ready to be back to the office, and that's not going to happen. What we're paying attention to is we're about 30% occupied. If you walk around in the 10 blocks surrounding us right now, buildings are about 30% occupied for office buildings, but the actual apartment buildings are at full occupancy and back to pre-COVID rents. So that's just a fundamental we didn't expect. And I don't think everyone's gonna be back in the office January 1, 2022. So the question is, was that a false reaction to the market? Is rent growth going to, maybe not taper, but not grow until we get most people back to work? I don't believe that we're going to be all remote and fragmented workplace. I think we're probably going to see somewhere between 5 and 10% remote workforce. That's not too different than it was before. We're going to take up a little bit more office space per person, and net, there probably won't be much difference. So the question is, how long does it take for those fundamentals to play out? And I don't think 2022 is dead certain it's all going to be lift. I think we are in a pinch yourself market that everything is going so well as quickly as it is. We'll talk about the long-term forecast in a couple of moments, but I think from a near-term perspective, it's being smart about your long-term goals. If you're a seller, now might be the time. If you're a holder, don't sell. But how do you position yourself through what could be some oscillations next year as we figure out what the new normal is? I think we're going to clear all out of that by the end of next year, and people are just going to get back to work, and we're going to be through that. But I think it's going to take about 12 months for those oscillations. Finally, looking at some long-term forecasts, some key takeaways from our research and how we're looking at the market. First one is we're back. We're back on the national radar. We're back on the international radar. We made it to ULI's hit list. We're number 9 again. I don't know what that means. It means mostly there's a lot of confidence in the market, but I think people overall have faith in this region. There was a lot of skepticism in the region. I had a lot of friends call me asking if my house was on fire because they saw what was happening on Capitol Hill. I explained to them it's not, but other things were on fire. I did drive by a live dumpster fire at 5 a.m. about June 15th last year. That was interesting. So I can say I lived through the dumpster fire era, but we're back. People have confidence. The lenders are back in the market. The capital providers are back in the market. If Bellevue is the starboard side of the ship, we've got a little bit of a list on the starboard side that there's a lot more over there, but we're seeing people break ground in Seattle. We're starting to see some higher price sales in Seattle versus Bellevue. So we're broadly back. I don't think I have a great positivity. We're not going anywhere, but it's all investor sentiment. Next is the great debate, Seattle versus Bellevue. The best thing to happen to Bellevue is Long Island, New York. The best thing to happen to Seattle is Bellevue. And really just how they are playing together now and will in the future, I don't see Bellevue just taking off to the deficit of Seattle. I love Bellevue. It's a great market. I think there's tremendous fundamentals. We've got a lot of young team members that live on Capitol Hill. They are not moving to Bellevue. They want to be where the action's at. They want to be where the dating life is at. But I think we're going to see a rebalance and a redistribution of capital from investors. And I think the renters want to be where it's fun and where there's nightlife. And there is increasingly that in Bellevue, but it's not as much as Seattle. And I think as people are cresting their 30s and want to plant roots, they're going to want to be in that first ring outside of Seattle to the north, and they're going to want to be on the east side if they can afford it. So I think there's going to be a rebalance there. The final, or the next takeaway that's a carry-on from this is what we're calling Twin Cities superpower. And what's happened with what's going on in Bellevue, Bellevue is going to grow its footprint this next decade by about 10 million plus square feet of Class A office, is we're going to be markets that have 2 superpower cities, and that is having an impact across the region. And what we're going to see is not just someone moving out of Seattle to Bellevue, it's someone who might move out of the region and they're going to go into Kitsap County or Pierce County. All of these markets are going to grow, and I think it secures our places more like a Bay Area market, not Bay Area COVID, but Bay Area where it's been for the last 30, 40 years, is just a superpower region that attracts talent. The talent likes the livability in the region, and they're not all going to land in the middle of San Francisco or the middle of Silicon Valley. They're going to relocate in all directions, but they're going to stay proximate to those job centers. And I think what's happening in Bellevue right now is an early sign of that. And although most investors want to be smack dab in the middle of Bellevue, and I get it, and they don't necessarily want to be smack dab in the middle of Seattle, by the time we rebalance the next 24 months, we're going to see this entire region grow and strengthen. And that's why I think there's some tremendous opportunities outside of the core, even though they're expensive. because if you relate them to other markets, they're still not that expensive compared to other markets. And I don't think people are focusing as much. They're looking at this binary. Are you in Seattle? Or are you leaving the state? If you look at the metrics, we did not have that much out migration. San Francisco Bay Area did not have that much out migration. People just, the deck got shuffled differently. And then the final point is just new normal. I think we're waiting for Seattle to change and the politics to change and the grittiness to change. And I don't think it's going to. I think every urban city I've been in and lived in, whether it's New York or Munich or San Francisco, they're gritty cities. And I'd like to correct some of that. And I don't want to see that in our city. But I think we've had a wonderful existence here of being blind to that in these urban centers. Does it make it a bad place? No, it just makes it a place that we have a new expectation and we want to try to improve it. We all need to participate. We're riding the ship with politics. But I do think we're in a new normal in this region where we have to be more involved politically. We have to deal with these social issues. And there's going to be some urban grittiness that we might as well embrace and figure out how to own it and make it better than these other cities, but not run from it and just go somewhere else, because that does attract people. It does attract, from a cultural standpoint, some diversity. And that's truly what we have in Seattle. So I think it's a good thing that we've grown. I think there's challenges brought along, but I think overall, me and the team as well is just really excited to be back here on a podium 2 years later, not saying stick with us or recovery is coming. The recovery has happened, and I can't imagine a better set of circumstances than where we are now of moving forward for the next 10, 20 years in this region. So thank you for your time. Really excited to be here with all of you today. The team has had a wonderful year of interacting with all of you. In addition to the 6 brokers on our team, again, thanks to Cassie in putting this all together. Thanks for Jack, who knows how to use Excel better than all of us, thank God. And thanks to all of you for following us through this journey and being here with us. We'd love to work with you coming into the new year. You can always follow all of our data. You know how to get to our website. Our listings are on there, our research is on there, and you can learn a little bit more about the team there. We'd love to work with you in the new year. We're already working with a lot of you, and we've got a big pipeline for next year. So want to thank all of you for coming today, and stick around if you'd like to chat some more. And thanks for welcoming us all back.